My name is Yashiria London, and I researched the new lease accounting standards and why the implementation of the new standard is so vital. The accounting for leases has been an ongoing issue since the late 1940s. Previously, most companies didn't think it was essential to pay close attention to leases within the financial reporting process. In 2016, the Federal Accounting Standards Board amended the Federal Accounting Standards Board codification and created Topic 842 for leases. The purpose of this update was to increase transparency and comparability among organizations by recognizing lease liabilities on the balance sheet and disclosing key information about leasing arrangements. This topic is important because leasing is used by so many entities. Topic 842 affects any entity that enters a lease with some specified scope exemptions. It is also important that users of financial statements have a complete and understandable picture of an entity's leasing activities. This update, along with the International Financial Reporting Standards 16 leases, are the result of the Federal Accounting Standards Board's and the International Accounting Standards Board's efforts to improve financial reporting. A few of the main points included in my research paper include what a lease is, why the change was necessary, and who is affected by the update. Also, the previous lease accounting standards and the main difference between generally accepted accounting principles and Topic 842. Lessee accounting. The core principle of Topic 842 is that a lessee should recognize the assets and liabilities that arise from leases. All leases create an asset and a liability for the lessee in accordance with Federal Accounting Standards Board Concept Statements Number 6, Elements of Financial Statements, and therefore recognition of those leases assets and lease liabilities represent an improvement over previously generally accepted accounting principles, which did not require lease assets and lease liabilities to be recognized for most leases. Up until the new standard was introduced, accounting for leases required lessees to classify leases as either a capital lease or an operating lease. Lessees are required to recognize a right of use asset and lease liability on the balance sheet for all leases having a term of more than 12 months. Capital leases were recorded on the balance sheet, whereas operating leases were disclosed as a footnote in the financial statements as off-balance sheet operating expenses, and thus were excluded from operating financial ratios that allow stakeholders to judge companies' performance. In conclusion, there are key differences and similarities to both the previous and new lease accounting standards. The biggest impact of the new standard was recognizing leases on the balance sheet. In the former lease accounting standard, operating leases did not impact the balance sheet. Previous lease accounting was criticized for failing to meet the need of users of financial statements. The new lease accounting standard offers more data about leasing arrangements so that users can assess the amount, timing, and uncertainty of cash flows from leases. The new requirement was necessary to account for future commitment in a way that is consistent with other liabilities.